Hello, and welcome to the June Market Update. My name is Brad McMillan. I'm Commonwealth's Chief Investment Officer. We had some good things in May. We had some bad things in May. It wasn't the best of times. It wasn't the worst of times, but that's a pretty good phrase, don't you think? Let's start with the good stuff. U.S. markets closed positive across the board, up between 1% and 3%. That was driven by very good news from corporate earnings. Corporate earnings actually were up by about 1% for the quarter, which doesn't sound great and which we normally wouldn't be excited about, but we expected earnings to be down by about 5%. So in context, that's a huge positive surprise. It actually gets better because if you take out the oil companies, if you take out the energy companies that really got hit hard by the decline in oil prices, earnings were up by over 8%. This is much, much better than expected, and the markets are starting to digest that, okay? Companies actually are taking advantage of the growing U.S. economy. The U.S. economy was reported to have shrunk in the first quarter, which is not good. But at the same time, that was due to two one-time factors. First was a lousy winter. Not as bad as last winter, but still the Northeast, for example, had the worst winter ever. Second thing was the strikes at the West Coast ports. That screwed up the supply chains for everybody, retailers, manufacturers, everybody, and it had a huge effect. Both of those problems have since been resolved, so we expect to see growth accelerate, and in fact, that's what we're seeing, although not as fast as what we would like to. That's actually an interesting thing going on. I'm not that worried about it because the fundamental engine of the economy, which is jobs, continues to do well. All of the job indicators continue to be very positive. And in fact, over the past 12 months, we've created more jobs than at about any time since June 2000. The reason we're having slower growth is because we don't have people growing their spending as much as historically they would have done. They're making the money, they have the jobs, the income is growing, but they're not spending it. Instead, they're saving it. I'm actually okay with that for a couple of reasons, the most important of which is when we save money, we're laying the groundwork for future growth. We're making sure that the growth we have right now is sustainable. Growth based on money that we actually have is good growth, and that's exactly what we're seeing, and it lays the groundwork for that growth to accelerate later, which is exactly what we want to see. So the U.S. is actually in pretty good shape despite some of the bad news that we've had. The problem, and the reason the markets have been kind of back and forth over the past several months, is Europe and international risks. The headline right now is Greece. Now, we've heard about Greece before. We've been talking about Greece, it seems, forever. But right now, we're running into a very important deadline in early June. Greece has to pay back money. It has to pay back money that it does not have. And the political situation is getting tenser and tenser as we get close to the deadline. This could be a significant event for Greece. It could be a significant event for Europe. And that's, in fact, why we saw European markets pull back at the end of the month to a loss. It shouldn't be that big a deal for the U.S., okay? There is systemic risk there, but this time everyone knows it's coming. It's very well telegraphed. There should be volatility, but at the end of the day, the U.S. is well positioned to ride it out. So with that, we can talk about that next month, and thank you very much for tuning in.